Hello and welcome everyone to today's special discussion on the very evolving landscape of real estate and real estate tech. Today I'm excited to have Peter and Dan, the co-founders of Alpaca Real Estate, joining us to share their insights on real estate tech, and all things real estate investing. Guys, thank you for making time. Thanks for being here. I'm really excited to have this discussion with you guys.
Thank you.
Thanks, Ash.
I would love to, start the discussion by understanding, first of all, your background and discuss, why Alpaca Real Estate and how does your understanding of the current macro real estate cycle shape, your strategic focus in Alpaca?
Yeah, absolutely. So I'll start off and then pass the baton to Peter. But Ash, that's the exact question of the day, right? Why now? And why now is because the capital markets are in disarray, and that's creating a fantastic opportunity for real estate investment. So, backing up, Peter and I have known each other for about a dozen years. We worked together at JP Morgan in the real estate and lodging investment banking group and have been really fast friends ever since. We done a bunch of deals together. We started a networking organization in New York. So, we've talked about start careers every couple of months, and we were sitting in a restaurant in Midtown in around Christmas time in 2022. And we were looking back and we're saying, look, we've done a decade at large shops. I was at Ares Management, saw that company grow from 5 billion of real estate AUM to 55 billion of real estate AUM. So huge growth. Peter similarly was at Prospect Ridge, which was a spin out of Alliance Bernstein, a really high performing opportunistic fund. And we said, if we're going to create a differentiated fund offering, when should we do it? And we really couldn't think of a better time than right now. And that's because many real estate investors are sidelined. Both debt and equity players are taking a step back. They're waiting for, I would say, the next shoe to drop to see what happens in the macro economy. And that creates an opportunity for new entrepreneurial investors to come in, take advantage of distressed situations or situations that there just isn't enough capital looking at, and create great deals. So, with that general understanding, we sat down with a blank sheet of paper and said, what should this all look like? And really on the top of that sheet of paper was innovative, because we have been at these large shops and we've seen great deals. We know how to generate a macro thesis and then go execute it on the ground and generate consistent, high-performing returns. But what we've also seen is that large institutions aren't always the first to adopt new practices. And so we were pretty fast friends with the folks at Alpaca VC. Alpaca VC has run 5 funds so far in the technology and associated seed capital landscapes. And we're talking to them and saying a lot of the technologies that you guys are investing in, both with the typical prop tech and then also with climate tech, can really add outperformance to the typical real estate deals that we see. And so we saw a great opportunity for outperformance there. And that's really what led to the birth of Alpaca Real Estate, is the recognition that we are upside down in a real estate cycle. So this is going to be a very good time to start investing. And then also that there's a lot of really unpicked apples that are hanging low on the tree that we can go and start applying to the assets that we're investing in.
You know what it's really interesting you say that, because it sounds like you're using innovation and an innovative mindset as a hedge, or as a hedge against against inflation and potentially default and operational efficiency.
There's a couple of things I'd add there, Ash. I think on the one hand, you're absolutely right. On the other, what's really interesting, and one thing that caught Dan and I as we were putting together our white paper and business plan on this business was, not only is there volatility in their capital markets, but unlike other cycles, the operating fundamentals of some asset classes are incredibly strong. And so where we started was, when can we go on offense when others are on defense, right? So we have no legacy asset management issues and can, create the opportunity to go and invest in real estate today. But on top of that, there are a handful of asset classes, and we'll talk about 2 of them today in the residential and industrial space, where demand is still strong, we're still seeing rent growth, and there's tremendous tailwinds.
Yeah.
And so when you pair those two, and then you add the expertise of the technology and the accretion on top of those high quality real estate business plans, what we think is you just get a differentiated platform.
That's awesome. I totally agree with you. Without jumping too far ahead, we know that that interest rates are hovering around historic highs. Like it's like we all feel it, we all see it. The capital, the markets are reacting to it, right? And that's caused a little scrutiny. The markets are kind of scrutinizing the Fed's monetary policies and a whole bunch of other stuff. And we'll kind of put that aside, right? But understanding the state of the real estate market, how has the interest rate environment impacted the real estate environment, and how you go about actually operating those assets?
Yeah, so this time in this cycle, right, it's the real estate market that's impacted by the Fed, and it's not vice versa, right, where the real estate is creating the issues. We're kind of caught up in the issues.
Mm-hmm.
But I think what's interesting is just, the Fed has raised the benchmark rate 11 times since
Mm-hmm.
March 22. It's been about a year and a half. We're at a 22-year high. They did that to fight inflation, which we lived through during COVID. But what's interesting is then cap rates and valuations lagged, right? And so what we've seen is we're seeing values reprice within the broader real estate universe. And as I mentioned, you've got these asset classes that are still quite healthy, but at the same time, values have to come down because rates have jumped so much. And so what we like about that and what we see within that is that we have the opportunity to buy at this reset pricing because of the phenomenon that the Fed has created through these 11 hikes.
Mm-hmm.
And what's uncertain right now is that the Fed hasn't stopped yet, and they haven't said when they are going to stop. So we're 11 hikes into it. There could be more. History would show that once the Fed stops their rate hike cycle, there's 8 to 14 months before the Fed kind of turns the ship around, and that's when I think we'll kind of officially be in that next cycle of growth. But what that means is we're probably in a 2-year or so period of time of continued uncertainty. And for institutions and for a lot of competitors during that uncertain time frame, there'll be less transaction volume. And what that's going to lead to is if you can be a liquidity provider when others aren't, there's a lot of opportunity.
Yeah. Speaking of liquidity and innovative business models, there was an interesting study by the Urban Land Institute, the ULI, and specifically talking about residential. Like, let's kind of dive into residential for a sec, right? The residential sector, particularly around single family rentals, SFR, and build to rent, like BTR models, have experienced approximately 20% growth in investment year over year. SFR is huge. It's becoming more and more institutionalized. BTR already is, right? These models in the residential sector, while they're not new, we're seeing innovative takes on them. Can you just elaborate? I know you guys did a deep dive on the sector. Can you just elaborate on just like where do you see the innovation in those sectors, and how do you plan on like leveraging innovation to an innovative mindset to kind of generate better results?
Yeah, absolutely, Ash. So you mentioned the deep dive. So really, our investment process starts with a deep dive or a white paper, really, that's looking at the thematic trends within a sector, and then we go from there, and the conclusion of that white paper is a buy box for how we would want to invest in it, and then finally the actual investment plan. Who would we do it with? Mm-hmm. How would we effectuate getting positions in those assets? So in our prior roles, we had a lot of experience in both SFR and BTR. We saw the institutionalization of the sector. And interestingly, you note that it's becoming institutionalized. There's a couple of REITs out there, but still the institutional ownership of homes in the United States is sub 5% of total home stock. And so there's a lot more opportunity for institutions to participate in this sector going forward. But we had a couple of key observations that really came out of this white paper process. On one side, home price affordability is dismal. That's because interest rates for the average homeowner have gone up to over 6%. just that change have knocked over 20 million homeowners out of being able to afford a home. Now, those aren't people that don't want to live in homes. They want the space. They want the space for their families, but they can't afford to do it right now with where mortgage rates are. So that's creating a lot of demand for SFR or BTR on the sort of retail renter side. At the same time, the lack of capital availability through the capital markets is creating the opportunity for us to go in and supply that product. What I mean by that is we can buy completed homes from home builders. We can enter into joint venture partnerships with developers to go build tracts of homes. And there's really a lot of demand for the capital to do that. So we're seeing demand from both sides. One, from the home builders and the developers who want to partner with us, and then two, from the end user who wants to rent that product. That's not typically something that you see in a typical environment where we have really strong demand, but the capital just isn't there to satiate it. So that was the overarching theme that said, all right, well, we really want to continue investing in this space. When we took it to the next level, we saw, well, there are a couple of pretty interesting overlays or partnerships that we can do with companies that are not yet being integrated across the landscape. And that can be things like EV charging, it can be things like build to rent models. It can be things like short-term rentals. If you're building swaths of homes in markets that have high amounts of tourism, a short-term rental for a portion of the community could be a really interesting revenue generator. But there are all these different options and opportunities that are more nascent today and aren't integrated generally across large portfolios, but are great opportunities to go out and be innovative.
Is SFR like this sector that you guys like are deeply focused on right now, or is it like a bunch of sectors?
Yeah, I would say what we're trying to do is be very focused on a few sectors.
Yeah.
So SFR slightly, it's more BTR. I think the opportunity to create new product today and rent that new product out to a would-be home buyer is very interesting. If you look across the sort of macroeconomic statistics, rent growth within both the SFR and BTR space is forecast to be between 4 and 5% across the top 20 markets. Yeah. And that's likely in excess of what we're seeing on the multifamily side. There's been a lot of multifamily supply that's come online. Those are typically 1 to 3 bedroom apartments, but BTR is typically 3 to 4 bedrooms. So it's catering to this family landscape that isn't able to afford a home right now. And the macroeconomists are forecasting that would generate some excess rent growth over the next couple of years. So
it's quite
that's the space
interesting.
we're spending time.
It's like when you think about it, right? You have this you have the BTR model, SFR model. These are great, and then you have like the psychology of the home buyer. And if you look at millennials and just everyone between, right? Like that are trying to buy homes or first-time home buyers. And you ask them why they're trying to buy homes, the first thing that always comes to mind is always stability, right? Like, and then you have the appreciation of the asset, right? Along X amount of years, right? Not like a conventional multifamily where you have depreciation, all that stuff you have the benefits of, but you still have, a value appreciation over time. And some of the criticism I've heard from these rent to own models is that they lock you in, but you do not participate in the appreciation value over time. They lock you in at a rate, and then you don't. The value, the benefit still goes to the investor, not to the homeowner. The value to the homeowner comes at year 5 or whatever the number is. It's just an arbitrary number at a specific purchase price at that point in time. At that point in time, they have to get conventional debt. Like, seeing both the debt and equity side of the business, do you think there's a place where innovation can create better opportunities that are synergistic between both the investor and the consumer?
Peter, you want to run through the BTR and RFP process we're looking at and the rent to own front?
Yeah, it's almost like that was a perfect softball setup, Ash. But
was it?
Yeah, well, look, part of our process at Alpaca, and I guess I'll take a step back and then I will answer your question directly, but it is two-pronged, right? So you asked if SFR and BTR is our focus, and really what we're endeavoring to do is we're doing a deep dive into an asset class. And our asset class in this example is residential, and within residential, the conclusion of that study was to focus on BTR because of the rent growth forecast for the next 3 to 4 years that Dan mentioned, because of the demand fundamentals, both on the renter side as well as on the developer operator side. And then similarly, and we'll get to it, we did a deep dive on the industrial sector, and we have kind of sub specific angles within industrial, and we'll continue to do that as we grow and expand our business from an investing perspective. Then on top of that, what we're doing is there's incredible synergies with Alpaca Venture Capital, because they've invested in over 100 companies on the PropTech, climate tech, sustainability side. And what they provide is the opportunity to spend time with CEOs and founders that are being innovative. So within the BTR space, and you mentioned rent to own, what we've done is we've market mapped that sector, and we've found 9 or 10 companies that are doing that, right? They're players from the most institutional that's got rent own on 18,000 homes to some more nascent companies that we're looking at investments in. And one of the things that I think you called out was home price appreciation and the importance to the consumer. Well, what we found in that market map is there is a company out there that does provide home price appreciation to that consumer. And effectively what they're doing is they're sharing in the home price appreciation. And so you set a value of the home today, you set your rent today, then you effectively have an option contract, and at the end of that option contract, if the renter wants to convert that option and purchase the home, they actually participate in the home price appreciation on a sliding scale. So they get a little bit of both. So they don't get 100% of the ups or 100% of the down, but they're paying an effective rent over time. And then at the end of the day, if they want to buy the home and the market has run, they're not paying the fully baked price at the end of the day.
That's interesting. So it sounds like you guys are looking at both the multi-tenant and single tenant spaces.
We are,
Yeah.
specific to this overlay within BTR, the way that we think about it is we run a demand segmentation analysis. And so we'll do a deep dive into the demand for that specific MSA for the location to try to better understand the rentability of the homes. And then also if there's excess demand to purchase the homes. And then what we'll do is we'll work with the developer as well as with the operator to figure out how many homes should we set aside for something like a rent to own model. And what do we think the accretion is to that premium.
Yeah. Do you think there's any synergies between what's happening in the residential sector and the industrial sector?
In what way?
So like when you look at the built to rent models across multi and single family, and then you look at what's happening in the industrial sector and the growth, it seems as though there's price appreciation across both those categories. And then where we're seeing compression is on conventional multifamily and office, right? Office for sure, right? And the reason I bring that up is it's just quite interesting because there's a study by JLL that reported that there's a 50% uptick in demand for multi-tenant industrial spaces. I don't think that's a coincidence. I think you're starting to see as consumers, home buyers moving into these suburban or urban these suburban markets, with demand increasing for single family rentals and built to rent homes, logistics needs to be in place too, right?
Yep.
Right. And so, knowing that there's an uptick in that sector, I'm just curious, do you think that there's a play, is a coincidence that the industrial sector has also appreciated simultaneously with the residential sector?
Yeah. So I guess a couple answers.
It's a loaded question, a bunch of stuff in there. I'm so sorry.
Yeah, but on the one hand, you have industrial development almost similar to multi-development in terms of since COVID. And the craziest stat that I took away from COVID comes from e-commerce, which was that there was 42% year-over-year revenue growth for e-commerce sales during 2020. And that's really accelerated the e-commerce sector, which accelerates infill multi-tenant warehouses.
Yeah.
That growth in those businesses is going to continue to outpace brick and mortar retail. And the forecast is 6.5% growth through 27. So there's a ton of growth that's going on in the e-commerce sector. And we know there's a ton of growth going on in industrial generally. What we've noticed from the residential lens to answer that part of the question is that continued development of industrial buildings, which are getting further and further away from city centers, has led to additional residential growth. A lot of it has been multifamily, and a lot of that multifamily has been garden. And because of that added supply over the last cycle, that's why the multifamily sector is a little bit softer these days than comparable SFR. And rent forecasts are continuing to be positive, but they're low. And what we're seeing in the single family and BTR sectors is there's more robust growth just because there's been less supply. But what's more intriguing, and I think your question was multi-tenant industrial, and what we're spending time on from our market mapping and white paper process is the infill multi-tenant industrial space. What we like about that specifically is it's actually really hard to add supply because the locations of those buildings are closer into city centers. They're kind of last mile type distribution facilities. And so what we've found over time is, before this boom in industrial, more properties were actually getting taken out of the supply pipeline than added. And so you had pretty stagnant supply. And so what that led to with an industrial boom is you had vacancy rates going way down. And so what we're seeing today with e-commerce demand growing without a lot of supply in the infill sector generally is that you have the opportunity to continue to get excess growth within that category. And that's within an industrial marketplace that we really like.
Wow. I mean, I think it's super fascinating when you talk about the infill opportunities and city centers. I think it's quite interesting. You mentioned something in there, and that was location, right? And our business runs on the age-old adage, location, location, location. There's some insights by a company called there's a Geodata Insights that show that regions in the Sun Belt and the general Southeast, are experiencing faster growth rates in transactions and affecting both risk and return on those investments. I'm just curious, like we're talking about these innovative models and what have you, but at the end of the day, we're talking about real estate. Like, are there any geographies that are currently capturing your attention? I'm just curious. And why specifically?
Yeah, absolutely. Look, I think to be a successful real estate investor, you have to be local. You have to know exactly where you want to be investing, and then you need to understand everything that's going on in that market in order to find the best risk-adjusted return. Right? You don't want to be the guy that shows up and takes, or the girl that takes the average deal. You want to go through every single deal and find the best one. That takes really being focused on markets. And so, to take a step back, during COVID and really right after COVID, there was one of the largest population shifts in recent United States history from high cost states in the Northeast to lower cost, higher quality of life states across the Southeast and the Southwest. And so that population shift has slowed, but it's still very apparent. And for example, 7 years ago, if you were a financial services employee, you probably weren't looking at moving to Miami out of college, right? Maybe you were looking at New York, Chicago, but Miami probably wasn't the top of your list. Now it's probably within the top 3. When I go down and look at rent rolls, when I'm doing due diligence on buildings that are in South Florida, one thing that's been really amazing to me is it's actually population shift, not always with job growth. The two are different. And the reason they're different is because of the Zoom economy. And there's plenty of people, if you go through and look at where they're working, where maybe they work for, they're administrator at a health system in New Jersey, but their job is 100% remote. So now they're living in suburban Miami and like Broward County in a townhouse that they're paying $3,200 a month for. But that rent is so much less than what they would be paying in New Jersey. By the way, the taxes are less and their cost of living is less, but their quality of life might be higher. They might have a nicer home with better weather, with better access to amenities, and they're able to now port that income from that higher paying job in the Northeast and perform that job and reap all those benefits in the Southeast. So we sort of noticed that, and those are areas that we're really focused on, and that's where we think there's really strong growth. But also want to be, make the point that in every different type of asset class, there's a different geography that we may be more or less excited about. So when I talk about Southeast and Southwest, specifically really for BTR, because that population shift has created a lot of tailwinds in the BTR space. But for other sectors, you may want to be in an urban location, you may want to be in a higher cost location like New York City.
Yeah, I'm curious because like so we have Miami or Miami-Dade, right, in Broward County. Um, Texas always comes up in conversations when I'm speaking with investors. It's like Dallas specifically, not so much San Antonio, but Dallas specifically, Austin, but Dallas and Houston because of a diverse economy, um, and then Nashville keeps coming up.
Yeah. So
Right?
Peter's done a bunch of business in Nashville. He can shed some light on that.
Yeah,
I love Dallas for the simple reason that for the past 10 years they've added 150,000 jobs per annum.
yeah,
That is a hard stat to compete with. That means that the Metroplex is expanding and that there's just continued demand. There's no better solution for demand than jobs.
yeah,
And local jobs in Dallas are creating a lot of opportunity for folks to move there, for new restaurants to open up, new shops to be there and thrive, and just for the quality of life to be really strong. So I think Dallas is really right in the middle of our bullseye. Our two highest conviction markets are the south and west coast of Florida, and Dallas, specifically northern Dallas. So that's where we're looking. And then um, Houston, we have more mixed feelings about. I think certain areas of Houston that have a diverse economy, so that have exposure to the medical as well as the oil and gas industry, like in Southwest Houston, are interesting. But I think being totally exposed to oil and gas is something that we're unlikely to do. But Peter, you want to go through Nashville?
Yeah, so the Nashville story is very similar to what Dan laid out for Dallas. And we were exposed to that at Alliance Bernstein in making that incremental decision to move the AB headquarters from New York City to another market, and Nashville was the winner of that process. But what we saw through that, kind of starting in the 2017, 2018 timeframe and coming forward to today, was between Bernstein, Amazon, now Oracle is building a large campus there on the Cumberland River in River North. And because of all of that, the way the city responded, they're now building a brand new boulevard. The Titans are getting a new stadium. So there's a lot of development that's ongoing that won't even be complete until 27, 28. And a lot of those jobs, while being announced, they're not even there yet. And so when you think about forecasting demand for service level jobs, as well as the direct impact of those large institutions and the need for housing, you can see it in the numbers. And so that's kind of what's translated into the development of that city.
yeah. I'm curious. Speaking about where the opportunities are, which markets are actually maybe not avoiding, but maybe kind of doing a deep analysis and be more cautious. Some of the conversations I've had is, some investors are very wary of Orlando because of the primary economy that's driving Orlando is tourism and hospitalities. And when Disney and Universal have a decline in tickets sold and have you, that kind of scares some people, or it kind of shook some people, and taking a second look at that market and saying maybe it's what we thought. Like it's not all in high tide all boats float in the state of Florida. Orlando seems to be, from some of the conversations I've had, is like might be the exception to that rule, given the economy there. When you guys are looking at markets, it sounds like you guys are looking at job growth. But for existing markets that have been played up over the past 12, 24 months, are there markets that you're saying, I don't think this market
Yeah.
doesn't excite us yet, but it could in the future?
Absolutely. So I think Orlando is a good example where a lot of people are cautious. We would be cautious too. barring certain specific submarkets, right? And making like a blanket observation can be great for a commodity deal. There may always be a specific opportunity that you'd love to jump on.
Yeah.
But in Orlando, we're seeing on the residential front, over 20% of existing stock is currently under construction. And so there's a lot of supply that's going to be coming online. And as you pointed out, rents have already started to flatline. So as that supply comes online, rents are more than likely to take a step or two back. That's unlikely to be a place that we really want to go and continue to feed the fire, right? Build more. And as you also know, Orlando's really segmented towards the hospitality industry. So that means that the gross revenues coming into the city are likely to take a step back faster than other cities that have more diverse economies in a downturn, right? There, as Americans stop spending money at Disney and other resorts, that's immediately going to trickle down through the Orlando economy. But we look at other cities too that are mainly seeing an outcropping of supply, and that's where we get worried, where we just see the amount of supply coming in as being the typical real estate developer mantra of build until you can't anymore. Another one of those is Phoenix, where we see just a lot of supply coming in, and that the existing population and forecast population growth may not be able to support it. I think an interesting one that I think it has more question marks on it is Metro Washington, D.C. And that market has not come back since COVID. And the main reason is that while there are many jobs within that metro, the government has not mandated a return to work in a real in-person way. So downtown DC is a hard place to buy a cup of coffee these days.
Yeah.
Typically, it's been a very safe investment strategy. Be there. There's a lot of demand drivers. There are new technology-focused demand drivers like Amazon coming in, although that's not in DC, that's across the river in Virginia. So I think the story is yet to be written about how DC fares over the next couple of years, but certainly now there's a lot of distress to be had there.
It's interesting.
Yeah, Ash, the only comment I jump in on is like, for us, it can be very asset specific within a market, right? So we talked about Nashville. Nashville's seen a huge run up in hotel supply. And there's a big question mark on hospitality in Nashville, given how many hotels have been added to that market. Similarly, in Austin, which is a market we really like, there's been a huge run up in commodity industrial supply. And as Dan mentioned, that doesn't mean that there isn't the ability to get a site that you want to execute on from a business plan perspective for specific reasons. And if you get your hands on an infill site where there's no supply, you'd be all over it. However, it's a market that's probably going to see some flatlining from a growth perspective specific to industrial. That doesn't necessarily mean that the BTR sector is not healthy there or other asset classes. So as investors, we're very focused on the macro market one, but then we're digging in on an asset class by asset class basis to make sure that we really understand the supply demand dynamic of the asset class that we're focused on.
That's interesting. One thing I like about what you guys are working on is like, I love the white papers that you guys are putting together, and these theses around like your investment strategy. And the other part I like what you guys are working on is your partner type model. It was a few years ago when RCA said something like 30% of like real estate companies are considering or entering partnerships to gain market advantages. And I think that's quite interesting. And I think that's probably one of my favorite parts about what you guys are working on, is that you're not kind of going at it alone. You know what I mean? Like you're going as a value add partner. Are there specific types of partnerships or collaborations that Alpaca is considering to enhance its market options or market position? I mean,
yeah. So in our prior roles, we did all types of investing: direct, joint venture, preferred equity, various different structures. And one thing that was clear to me is that any economics lost through partnership are gained tenfold with sharpshooter expertise. And so that's something we really continue to do, and we thrive on our local relationships who have been in these markets for decades and are going to be the person that gets the phone call when that one piece of land comes back up, or the hotel didn't sell and it comes back around to one or two people. So we're definitely going to continue digging deep on our relationships to source deals. But another thing we've been thinking about is actually giving opportunities to our investors and structuring potential co-investment vehicles alongside the fund. And so as we think about the best way to allow folks to invest in real estate, one is through traditional funds, but then also through sector-specific co-investments. So if there's an investor that really likes a certain type of thesis and the way that a firm's attacking that thesis, then being able to structure a co-investment for just one or two investors can be an interesting way to give them more ability, more control, and the ability to really get in and gain exposure to a pretty interesting sector.
That's interesting. It's funny you say that, because there's a study by HBR, Harvard Business Review, that suggests that an ecosystem within real estate is the ecosystem within real estate is becoming more interconnected and involving a wider range of stakeholders. And I'm curious, like, what have been some of the most impactful learnings from your interactions within this ecosystem, and just from your personal backgrounds?
Yeah, it's funny you say that, because it's definitely an observation that Dan and I had as we started these conversations. The real estate industry is just becoming more transparent than it's ever been before. I mean, I remember, 10, 15 years ago, if you were digging into a deal, you were calling, local operators on the ground and trying to figure out rents from phone calls, and, writing things down for different floor plans for multifamily assets. Today, it's a lot easier for us to value assets, and we can do a lot more from our desktops than we could ever do before. And call that technology, call that interconnectivity, call that the growth in the brokerage and advisory businesses over the last cycle. But we have the ability to do that on a much more transparent way. And so when you have that ecosystem working together, especially in a less liquid environment like we're in right now, I think that interconnectivity just kind of allows for efficiencies and growth to come out.
Yeah.
And so that's kind of what we're seeing, and how we're trying to build our platform from the ground up. We're spending a lot of time on data collection. We're spending a lot of time on working through, from a pipeline management, asset management, portfolio management, how to work through all of those data points in order to make a more interconnected platform that'll be part of that interconnected ecosystem that you mentioned.
Yeah, it's funny when we say transparency, my brain automatically goes to aligned incentives, right? Like I think you cannot have transparency in and of itself is just basically a flashlight, right? Turning a flashlight on onto a situation. But I feel as if having aligned incentives with the transparency drives real results. And it sounds like you guys are like a philosophy-driven organization. I'm just curious, like, from an investor's perspective, what are some of the can you discuss some of the philosophies on the role of like these financial instruments in creating these aligned incentives within your real estate partnership structures?
Yeah, sure. So, the typical real estate partnership is invest in a deal with someone, and the day-to-day operator may make some excess returns via promote if that deal is successful. They probably also charge fees to the venture. And so one could argue that at a certain point, you're doing the math around how much fees is this operator taking out of the deal versus how much are they investing in, and are they getting a free option via this promote, right? If the deal does well, great for them. If not, they took so much fees out already that it was really fine. And so one thing that we're interested in is, specifically when we're looking at partnering with climate and technology companies that are going to come in and have either an overlay or we're going to work with them to source a deal together, how can we make sure we're not just in this fee-for-service business? And one way that I think is interesting is that if we are participating in growing their company, we should probably participate in the growth of the company via warrants.
Mm-hmm.
And having warrants that really only come into play if we are an integral part of the growth of their business is a great way to align incentives, because it takes away that worry about, hey, let me do the calculus on your income statement and let me compare that now to the potential promote or the potential investment that's going on to this singular transaction. And let's take a step back and have a much wider view on how we can be strategically working together across multiple transactions to create more value for your business. And if we do create that value, we should participate it in some way, but by in no means an unfair way. But that's, I think, one way that we're trying to think outside the box and not only focus on distinct real estate deals, but think more about longer term relationships and helping our partners grow their platforms over time.
That's interesting. So there's so CBRE released their Future of Real Estate report, and that suggested that the industry was going to face a range of disruptive elements, right? And so from a changing tenant, expectations to sustainability and ESG concerns over the next decade, right? So to that effect, like, how do you envision like the role of Alpaca kind of changing or evolving in the real estate landscape over the next decade?
Yeah, Ash, that's a big reason why we launched a new real estate private equity platform now, is because we wanted to position ourselves for the next 10 years of growth within the broader real estate landscape. And I think it's a lot of the things that we talked about. That's platform and asset level technology. It's the forward thinking revenue alpha generating tools that we think we can generate through these overlays, as well as the potential to, not only grow real estate pipeline through, some of the partnerships that Dan mentioned, but, also being at a time from a vintage perspective where we can be offensive when, quite frankly, the rest of the world has legacy asset management issues.
Yeah, that's awesome. So before I let you go, where I love, to kind of kick it back to you guys. Where can people learn more about you and the amazing work that you guys are doing?
Look, we have just launched, and so we're excited to talk to the entire world. And we're in our office 5 days a week on Fifth Avenue and 42nd Street. So you can find us online. You can find us on our website, obviously, but always don't feel shy to reach out directly via any avenue. We'd love to meet and talk.
Awesome. And to that effect, guys, thank you so much. Thanks for making time for us today. Really appreciate it. And congrats on launching Alpaca Real Estate.
Thank you. Thanks, Ash.
Thanks, Ash.